Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamilton, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're discussing a new report suggesting that home prices might be on the rise again in Ontario and across Canada. This report comes from the Royal LePage House Price Survey and Market Forecast, which was released recently. It's an interesting development, given that home prices have been declining from their peak highs in early 2022.
That's right, Steve. The report indicates that the aggregate price of a home in Canada increased by 0.3% year over year to $826,400 in the second quarter of 2025. It's fascinating how these numbers fluctuate, isn't it?
Absolutely, Janine. However, it's important to note that on a quarter-over-quarter basis, the national aggregate home price actually decreased by 0.4%. This highlights the market's complexity and the need for buyers and sellers to stay informed.
It's also worth mentioning that the spring market, which is typically a busy time for buying and selling homes, was quite subdued this year, particularly in major markets like Toronto and Vancouver. According to the report, many home buyers have adopted a cautious wait-and-see approach.
Yes, and that's likely due to a combination of factors such as the tariff threat in the United States and the Bank of Canada's lending rate holding at 2.75%. These external factors can really influence market dynamics.
Sellers, on the other hand, seem to continue listing their homes despite the lower than normal activity. It's a challenging environment for everyone involved, isn't it?
Indeed, Janine. Phil Soper, the president and CEO of Royal LePage, commented on this, noting that the spring market didn't see its usual surge in activity, which he attributed to uncertainty from trade disputes, a federal election, and international conflicts.
But there's a silver lining, Steve. Soper also mentioned that June's robust employment report could help rebuild confidence and bring more buyers into the market in the coming months.
That's a good point. The report did note some positive signs towards the end of the quarter, with activity picking up in places like Toronto. It's an early indication that market momentum might be shifting.
And let's not forget that the combination of rising salaries and declining borrowing rates has improved affordability in Canada's housing market, particularly in Ontario and British Columbia.
Yes, that's a crucial aspect. The report highlighted that national average weekly earnings have risen 11.8% between April 2022 and April 2025. This increase in earnings can certainly help offset some of the challenges posed by high home prices.
Interestingly, the aggregate price of a home in the Greater Toronto Area decreased by 3% year over year to $1,155,300 in the second quarter of 2025. Yet, on a quarterly basis, it remained relatively flat, increasing by 0.8%.
That's correct. And if we break it down by housing type, the median price of a single-family detached home decreased by 1.2% year over year, while the median price of a condominium decreased by 5.6% during the same period.
Despite these fluctuations, there are early signs of renewed confidence in the market. Royal LePage forecasts a 2% increase in the aggregate price of a home in the Greater Toronto Area in the fourth quarter of 2025 compared to the same quarter last year.
Yes, and across Canada, they're expecting a 3.5% increase in the aggregate home price in the same time frame. It seems there's a cautiously optimistic outlook for the housing market as we move into the latter half of the year.
Let's hope that optimism continues to build, Steve. It's always encouraging to see signs of a more confident and active housing market, especially given the global economic uncertainties we've been facing.
Let's shift our focus to Canada's inflation rate, which has seen a rise in June to 1.9%. This development likely spells the end for any hopes of a Bank of Canada interest rate cut this month. Statistics Canada reported this increase from May's 1.7%, which, while slightly below analysts' expectations, still indicates a jump amid ongoing trade tensions with the United States.
That's right, Steve. It's a challenging situation, especially for those feeling the pinch of rising costs. Mortgage interest costs have increased by 5.6% compared to last year, and rental costs are up by 4.7%. These increases can really affect household budgets, especially for families trying to make ends meet.
Absolutely, Janine. While these costs have risen, there has been a significant decline in other areas, such as gasoline prices, which fell by 13.4%, and airfare costs, which slid by 9.2%. These decreases can provide some relief, though they do not offset the overall impact of rising inflation.
And when we look at core inflation, which excludes volatile food and energy costs, it's still hovering around the 3% mark. This persistent elevation suggests that the Bank of Canada will likely hold its policy rate steady in its upcoming decision at the end of this month.
Yes, the central bank seems to be in a wait-and-see mode as they assess the long-term impacts of President Trump's trade policies on Canada's inflation outlook. With new tariffs on Canadian imports to the U.S. set to start in August and potential retaliatory measures by Canada, there's an added inflation risk on the horizon.
Despite these challenges, it's worth noting that the Canadian labor market showed resilience last week, adding 83,100 jobs and seeing a slight dip in the unemployment rate. This is a positive sign and suggests that the economy isn't heavily burdened by the current U.S. tariffs yet.
Indeed, Janine. Doug Porter, the chief economist at the Bank of Montreal, mentioned that the recent inflation data gives the Bank of Canada little justification to cut rates at the end of this month. He even described the solid employment report as the icing on the cake for maintaining the current rate.
And as Porter pointed out, a rate cut in September would require a significant deceleration in core inflation, unless there's a steep economic downturn due to the ongoing tariff uncertainties. It's a delicate balance for the Bank of Canada as they navigate these economic waters.
According to a recent poll from the MNP Consumer Debt Index, a significant 64% of Canadians are hoping for a drop in interest rates. This demand comes as financial anxiety continues to grow, especially among younger and lower-income households who are feeling the pressure from the rising cost of living and economic uncertainties.
It's really concerning to see how many Canadians are struggling, Steve. More than a third of them are feeling anxious or stressed about their finances, and a quarter are delaying major life decisions due to financial pressures. This isn't just numbers, it's about real people who are having to put their lives on hold.
Grant Bazian, president of MNP Ltd., highlighted that many Canadians have not faced such economic uncertainty since the COVID-19 pandemic. He pointed out that while there's some stabilization in financial perceptions, numerous households feel stuck in a financial holding pattern.
And with the Bank of Canada keeping rates steady at 2.75%, there's a lot of worry about what might happen if rates were to rise. In fact, 41% of Canadians are concerned that rising rates could push them toward bankruptcy, and almost half are worried about their ability to repay existing debts.
Yes, and despite these concerns, a rate cut seems unlikely in the near future. The Bank of Canada has kept rates steady in its last two announcements, especially considering the ongoing global trade disputes and potential tariffs from former U.S. President Donald Trump.
It's a tough situation, Steve. But amidst all this, there are some small signs of improvement. The average amount Canadians have left over at the end of the month has increased to $916, and some age groups and income brackets are starting to see a little financial relief.
That's right, Janine. Bazian noted these are small but encouraging signs of financial stability. However, it's crucial to remember that around 14 million Canadians are still close to financial insolvency, with minimal capacity to handle unexpected costs.
And it's particularly hard on younger Canadians and those with lower incomes. Among 18 to 34-year-olds, 45% report financial anxiety, and 37% say they're living paycheck to paycheck. It's a tough reality for many, and it highlights the need for effective financial support and planning.
Now let's turn our attention to some significant developments within the Financial Services Regulatory Authority of Ontario, or FSRA. Houston Loke, the inaugural Executive Vice President of Market Conduct, is set to step down from his position at the end of the month. Janine, this is quite a notable change for the organization, isn't it?
Absolutely, Steve. Houston Loke has been a pivotal figure at FSRA, especially in shaping regulatory strategies across several key areas such as mortgage brokering, insurance conduct, and title protection. His departure marks the end of a significant era for FSRA, given his instrumental role in modernizing regulatory practices and enhancing stakeholder engagement not just in Ontario, but across Canada.
Loke's contributions have indeed been substantial. As chair of the Canadian Council of Insurance Regulators from 2023 to 2025, he was at the forefront of advancing interprovincial collaboration focused on consumer protection. This kind of leadership is crucial for ensuring that regulatory frameworks remain robust and effective.
And let's not forget his efforts to improve advertising standards in the mortgage brokering sector. Earlier this year, FSRA introduced draft guidance to minimize consumer confusion by requiring that advertisements using team names clearly disclose the authorizing brokerage's name and license number. Loke emphasized the importance of clarity and transparency in these practices, which is so vital for consumer protection.
That's right, Janine. His background is quite impressive as well. Before joining FSRA, he held senior roles in Canada's financial regulatory space, including more than 6 years as Director of Corporate Finance at the Ontario Securities Commission. He also worked as an advisor to the Chief Risk Officer at the Canada Mortgage and Housing Corporation and held leadership positions at DBRS.
With such a strong track record, it's no wonder FSRA has expressed gratitude for his service and contributions. However, the organization is also preparing for this transition by planning to release a succession plan in the coming days. It will be interesting to see how they navigate this change and who will step into Loke's shoes.
Indeed, Janine. The departure of a leader like Loke can be challenging, but it also presents an opportunity for fresh perspectives and new directions. As FSRA moves forward, it'll be crucial to maintain the momentum in regulatory modernization and stakeholder engagement that Loke has set in motion.
It's a time of transition, but also of potential growth and innovation for FSRA. As we bid farewell to Houston Loke, we look forward to seeing how the organization continues to evolve and adapt to the ever-changing landscape of financial regulation.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.